So with us today to give an outlook for the status of the U.S. corporate sector is Harry Colvin, senior economist at Longview Economics Research. This morning we will discuss the outlook for the U.S. economy in general, and with emphasis on the corporate sector and what this means for markets. And with us to do that is Harry Colvin, senior economist at Longview Economic Research. Very welcome, Harry.
Thank you, Stefan. I mean, I think the outlook for the U.S. economy, as we've been saying for a number of months now, is pretty poor. We're expecting a U.S. recession to start later this year, and that and part of that, of course, will be the corporate sector retrenching and cutting back and belt tightening, cutting costs, drawing down inventory, cutting capex, and then eventually shedding jobs. And one of the things that troubles us, of course, is this very sharp tightening of credit conditions in the banking system. And you can see it across the various surveys of credit conditions. They're all looking very tight, and they're leading indicators. They lead credit growth. And taken in isolation, they're telling you that bank lending really should be contracting pretty meaningfully over the course of the next 6 to 9 months. The relationship historically is very tight, and I find that to be a pretty compelling, a convincing signal there that we're going to see much more weakness in the banking system generally, but particularly in lending. And what I would say as well is that if you look at where the bank's exposure is, a lot of it, especially in the mid-sized banks, is commercial real estate loans. These banks have basically been doubling their commercial real estate loans over the past 10 years. They now account for about 30% of the loan book. And of course, when you've got tight credit conditions, that high loan book exposure, deposit outflows from the banking system generally, high office vacancy rates as well, it all tells you the banking crisis is probably not contained. We're going to see a hit to earnings, probably further bankruptcies amongst those mid-sized banks, a pickup in delinquency rates. So, I think the setup for the banking system and for the US economy is a lot like other times in history, particularly before World War II, when you had shrinking M2 money supply, which is what we have today. Generally, that generated the conditions for banking crises and for outright deflation historically as well. So that, I think, is the fascinating setup today. We've got super tight credit conditions. There's lots of vulnerability in commercial real estate. And then I would just add one other thing to that, which is that there's a liquidity squeeze underway in the corporate sector. Now, we like to think about that in terms of the corporate sector's liquid short-term assets as a share of short-term liabilities. And what we find is that generally just before recessions, those short-term assets fall as a share of liabilities. And, it's often a combination of both falling assets and rising liabilities. I think the interesting thing about that today is that, trade payables is the main driver of this big increase in short-term liabilities for companies, which has been playing out over the past couple of years. So in other words, companies have really been struggling to pay their bills. They've experienced tighter liquidity. There's pressure on their cash flow, which has been growing. And if you look at payables as a share of GDP, they've risen very sharply. It's just a sign that companies are struggling, and a sign that we've got the conditions for companies to start to tighten their belts and cut costs and generate that recession dynamic. Of course, recessions, they're all led by the corporate sector, really. It's corporates cutting back their costs. So that's a good sign that they're about to do that. So look, all of that, I think, is pretty troubling, and it sets the stage for recession later this year.
Yeah. A couple of questions there, Harry. We had the senior loan office survey is it's a good signal for how banks are thinking about lending, but you also have the other indicator where how's the CEO confidence survey. Can you just give us a brief description of these two?
Yeah,
signals?
absolutely. I mean, the senior loan officer survey. There's also the NFIB survey, the Dallas Fed do one. These are all really banking credit condition surveys. The CEO confidence survey is a bit different. It's asking CEOs how they feel about life. And I think the interesting thing about that is it's very negative, especially when you smooth it. The data is quite volatile, but when you smooth it, it's very low. It's close to multi-year lows, if not record lows. So, and it's telling you that earnings should shrink. It's a great leading indicator for earnings growth if you look at, say, forward earnings in the S&P, and it tells you that over the course of the next 6-12 months or so, we should see a much more marked fall in earnings growth, a much larger contraction. So that, I think, is a fascinating dynamic when you have very high valuations and an economy that's about to roll into recession. It tells you we need a derating of the equity market, but not only that, we're going to probably see shrinking earnings. And if all of that's right, of course, it tells you that the S&P is going to be trading at a much lower level. We think fair value on the S&P in that respect is probably closer to about 3,000. So much more downside in the US equity market over the course of the next 6-12 months or so.
Yeah, and the US equity market has been held up to a large extent by these very mega cap tech stocks, which are due to report this week. So we will see if they can continue to sort of counter this the negative scenario, or if they will start to give way as well.
And that's a very good point. Most of the increase in the market cap of the S&P has come from a small number of tech stocks this year. So, you look at the sort of other 480 or whatever, you split them out from the top 20 tech stocks. The other 480 actually have really been struggling in terms of their total market cap. So actually, the breadth of the rally in the equity market is very narrow, which of course for technicians is quite troubling.
Yeah, it's troubling. Just a final question, if you have time, Harry, on the VIX. Well, how come that the VIX is so low despite this?
Well, I think it's a sign of near-term complacency in markets. We've been trading in a very tight daily trading range in the S&P. Volumes have been reasonably light. Volatility, as you say, has fallen to very low levels, and I think it's all part of this growing complacency in markets in the near term. We've also had a bit of a fall in downside put protection in portfolios, all of which is consistent with this idea that there's a bit more optimism and complacency around, and at some point all of that's probably going to reverse, and we'll see a renewed move higher in the VIX, because that's what happens, of course, when markets become complacent. They eventually become fearful again. So I suspect probably markets rally over the course of the next couple of weeks, but then we're in for a larger drawdown in the S&P and a resumption of the bear market.
We'll see. I mean, it's a little bit scary, but hugely interesting. So we'll try to follow up on this within short. Thank you very much,
Excellent.
Harry.
Thanks, Stefan. Have a good week. Thanks.
You too. Bye.